Good evening. Tonight we turn our attention to gold, a symbol of wealth and security for centuries, and now, a key player in today's global economy. Gold isn't just for jewelry or electronics, it's a major investment and a barometer for economic health. As of December 15, 2025, gold prices are surging, reaching $2,330 an ounce. This isn't a random spike, it's part of a larger trend that's catching the eyes of investors and everyday citizens alike. Why now? The answer lies in shifting global currencies, government policies, and market sentiment. Understanding this surge is crucial. It reflects deeper economic currents that could impact us all. Tonight, we'll break down the forces behind gold's rise, its relationship with the US dollar, the impact of treasury yields, and why these matter to your finances. We'll also preview the upcoming US jobs report and touch on other precious metals for a complete market picture. By the end, you'll see why gold is making headlines and why it matters to your financial well-being. Let's dive into the story behind gold's gleam in today's economy. Stay with us. To understand gold's climb, start with the US dollar, the world's reserve currency. Gold is priced in dollars, creating an inverse relationship. When the dollar weakens, gold usually rises. Recently, the US dollar index dipped, making gold more attractive to international buyers. For investors in Europe or Japan, a weaker dollar means their currency buys more gold, boosting demand and pushing prices higher. This isn't just about affordability. A softening dollar can signal economic uncertainty, prompting investors to seek gold's stability. The current surge to $2,330 an ounce is closely tied to the dollar's recent slide. This classic market reaction is a key driver of short-term gold movements. Investors worldwide watch currency shifts, knowing a weaker dollar often means a stronger gold market. When confidence in the dollar wavers, gold steps into the spotlight as a safer store of value. The interplay between these two assets is one of the most reliable signals for gold's direction. Right now, the dollar's retreat is giving gold room to shine. This dynamic is central to understanding today's gold rally. The dance between gold and the dollar continues to shape the market, and investors are watching every step. Let's talk about US Treasury yields, another crucial factor in gold's rise. Treasury bonds pay interest, known as the yield, and are considered among the safest investments. Recently, the yield on the 10-year Treasury bond has dropped, making these bonds less attractive. Gold, by contrast, pays no interest. It's a non-yielding asset. When bond yields are high, holding gold means missing out on interest income, making it less appealing. But with yields falling, the opportunity cost of owning gold shrinks. Investors are more willing to choose gold's security over low-yielding bonds. This shift drives more capital into gold, increasing demand and price. The recent easing of treasury yields is a powerful tailwind for gold, alongside the softer dollar. Lower yields mean less incentive to hold bonds, so gold becomes a more attractive alternative. The decision between a non-yielding asset and a low-yielding one is easier when yields are low. That's why gold is gaining ground now. The bond market's moves are directly fueling gold's rally. As yields drop, gold's appeal grows. It's a simple equation: lower yields, higher gold. Investors are laser-focused on the upcoming US non-farm payrolls report, a key snapshot of the job market. This data influences the Federal Reserve's decisions on interest rates, which in turn affect gold prices. A strong jobs report could mean higher inflation and prompt the Fed to keep rates elevated, which usually pressures gold. Conversely, weak job numbers suggest a cooling economy, increasing the likelihood of rate cuts. Good news for gold. The market is already reacting to expectations of a softer report, fueling gold's current rally. Investors are positioning themselves ahead of the data, betting on a dovish Fed response. The anticipation alone is moving markets. A surprise in either direction could trigger sharp moves in gold prices. This week, jobs data isn't just about employment, it's about the future of gold. The stakes are high, and the outcome could set the tone for months to come. Gold's fate is closely tied to the health of the US job market. All eyes are on the numbers. Everything points to one big question. What will the Federal Reserve do with interest rates? The Fed's decisions ripple through the economy, affecting everything from loans to gold prices. Right now, markets are betting on rate cuts as economic data shows signs of slowing. The CME FedWatch tool puts the odds of a rate cut by March 2026 at 65%. This expectation is a major driver of gold's rally. Lower rates reduce the opportunity cost of holding gold and can weaken the dollar, both bullish for gold. Investors are buying gold now, anticipating the Fed's next move. The current price reflects this forward-looking optimism. Gold's future is deeply linked to U.S. monetary policy. Every Fed statement and economic report is under the microscope. The market is preparing for a new era of lower rates, and gold is leading the way. The connection between rates and gold has never been clearer. Beyond technical factors, gold's appeal is rooted in psychology. In times of turmoil, economic, political, or geopolitical, people turn to gold as a safe haven. It's a tangible store of value, trusted across cultures for millennia. When uncertainty rises, so does demand for gold. Central banks are also major buyers, using gold to diversify reserves and stabilize currencies. Recent years have seen central banks, especially in emerging markets, increase their gold holdings. This steady demand provides a solid floor for prices. Gold thrives when investors are optimistic about lower rates and when they're worried about the future. Its dual role as both opportunity and insurance gives gold its timeless appeal. In uncertain times, gold's safe haven status shines brightest. That's why it remains a cornerstone of global finance. Monetary policy isn't the only force behind gold's rise. Physical demand, especially for jewelry in countries like China and India, plays a huge role. Economic health and cultural traditions in these nations can swing global gold demand. Strong wedding seasons or festivals often boost prices. Industrial demand also matters. Gold's unique properties make it vital for electronics and technology. Even small amounts in billions of devices add up. On the supply side, gold mining is slow and costly, keeping new supply limited. This scarcity means even small demand shifts can move prices. Gold's value is rooted in both its rarity and its broad utility. The market is shaped by more than just investors. It's a global story of culture, technology, and scarcity. That's what keeps gold in demand. Gold isn't alone. Silver, platinum, and palladium are also making moves. Silver, at nearly $30 an ounce, is both a safe haven and an industrial metal, used in solar panels and electronics. Its price reflects both investor sentiment and manufacturing trends. Platinum and palladium, up modestly, are crucial for catalytic converters in cars and are tied to the auto industry's health. Platinum is also gaining ground in the hydrogen economy. Recent gains in these metals suggest optimism about industry and possible supply concerns. The rise across all four metals points to broad positive sentiment in the precious metals market. It's not just about safety. There's hope for industrial growth too. Watching these metals together gives a fuller picture of economic expectations. The precious metals complex is sending a strong signal about the future. Gold may lead, but it's not alone in the spotlight. What does gold at $2,330 an ounce mean for you? Most people feel the impact indirectly, through interest rates, borrowing costs, and economic confidence. Rising gold often signals expectations of lower rates, which could mean cheaper loans, but lower savings returns. It's a sign of shifting financial conditions that affect everyone differently. Gold's rally can also be a warning. Big investors may be worried about stability or inflation. It's a prompt to review your own financial plan. Are you diversified? Are you prepared for change? The story of gold is about more than metal. It's a signal of what's coming in the economy. Markets expect the Fed to cut rates soon, which could lower borrowing costs, but also reduce returns on savings. Gold's rise reflects a search for safety and a reaction to a weakening dollar. Even if you never own gold, its price is a powerful indicator of economic trends that will touch your life. Stay informed, because gold's story is your story too.